Hello everyone, this is Andrew McNair from SWAN Capital with our April 2023 SWAN Report. In this month's video, we're going to discuss some recent headlines that influence the financial markets, but I also want to provide you some perspective on what these developments may mean for you over the next few months ahead, what it may mean for you and your portfolio, what it could mean for your financial plan. But as always, please stay tuned at the end of this video for some required disclosure statements. At SWAN Capital, our market outlook is cautious because recent gains in stocks have been driven entirely by valuation expansion. Meanwhile, markets continue to second-guess the Fed's commitment to staying higher for longer, with expectations for rate cuts later this year fueling the recent rally. And I'll be one of the first ones to tell you that I don't believe interest rates are going back down. We continue to expect the near-term path forward for equity markets to be more challenging as recessionary pressures build, especially if the Fed officials keep monetary conditions tight or continue increasing interest rates, which we could probably see another 0.25% increase. Although the recent developments in the banking industry were meaningful and unexpected, they do appear to be idiosyncratic in nature. The nature of these bank failures highlights the pronounced vulnerabilities of today's financial system. Many companies and sectors are operating with very little margin, and we remain watchful for signs of additional stress that could emerge and create cracks and create further volatility in financial markets. And this happens anytime money is flooded into the economy. Investors will likely need better clarity on the path of inflation and Fed tightening, as well as the outlook for economic and earnings growth before a sustainable rally really takes hold. We need more clarity before knowing where we're headed. In the meantime, we remain focused on holding high quality, diversified funds, as well as making sure our clients have market hedges, what we refer to as wall accounts, to weather any recession that should lie ahead. Now, if we look at the labor market, check out the BLS report. Non-farm payrolls report in March showed we've added 236,000 jobs. The JOLTS survey, this is the job openings and labor turnover survey, revealed that the job openings actually declined to 10 million in February, a number we haven't seen in almost 2 years. Now, meanwhile, ADP reported that the private employers added 145,000 positions in March, and wages increased year over year by 6.9%. This is down from February when we added 242,000 jobs and wages were up 7%. The bottom line is hiring seems to be cooling gradually, and employment isn't showing nearly as quickly as the Federal Reserve would like to see. The stronger than hoped for numbers continue to diminish hopes for rate cuts and stoke recession worries. In other news, the Social Security Administration announced earlier this month that its trust funds, which are used to help pay for 65 million Americans' benefits, will be actually exhausted by 2034. That's 1 year earlier than previously forecasted. And my belief is that we do have to raise FICA tax to pay for it. Sadly, that is one of the reasons that you will probably see higher taxes after 2025. When the trust funds do run out, recipients could be paid about 80% of earned benefits. So fear-mongering should be limited because 80% of benefits will be paid out. Now, Medicare's fund will be running out by 2031. So what does this mean for Social Security? Will it be insolvent? No. Current workers are still paying into the system. But it does mean that Social Security and Medicare programs do need an overhaul. They will need to be addressed, and I can bet you that Congress will wait till the very last minute. So far, the Biden administration has proposed to tax who? The rich. They want to tax taxpayers with $400,000 in income or more, even though we all pay into Social Security and we all get something from Social Security. Neither Congress nor the White House have proposed plans yet for ensuring Social Security benefits for future retirees. That just goes to show you the lack of clarity in the administration. Internationally, other countries are also facing headwinds with their retirement systems. Protests persist in France as Macron's pension law being pushed through the House of Parliament without the vote. France is increasing its retirement age from 62 to 64, and this is controversial, but I believe the United States needs to do it way in advance. What they need to do is pick an age, maybe 40 years old. Whoever is 40 or 45 now, their Social Security age should be raised from 62 to 67, and then from the next age to 70, and then the next age from 70 to 72. By doing this, it will let the Social Security funds run out a lot slower. Remember, Social Security was not meant to be the sole source of someone's retirement, and it was not meant to fund a 30-year retirement. That's it for this month's SWAN Report, and I want to thank you for listening every month. If you have questions about your Social Security benefits and maximizing those benefits, and remember that the government has a good track record of grandfathering people into their benefits. So if you want to make sure that your benefits are grandfathered in the right way, give us a call at 850-380-9558, and we'll see you next month.